We have Mr. Kumar Subbiah, who's the CFO of CEAT, joining us for more details on how their business plans are right now being laid out. It's great to have you on the show, Kumar. I just want to start off by understanding how you're tackling the rise in raw material costs that has been pulling margins down. What's the outlook for rubber prices? How are you managing that, and how are you ensuring that you mitigate the risk on margins on account of this trend?
The outlook is raw material prices. We expect about 2 to 3% increase in the current quarter versus last quarter, and assuming that crude sustains at that current level of $75 to $80 per barrel levels, maybe another 2.5% kind of an impact we could see in the next quarter on overall raw material basket.
Right. Largely the analyst community believes that a higher share of OEMs in the sales mix, along with capacity ramp up, also impacting your margins, can be a source of contention going forward. Talk to us about the timelines for this expansion that is underway and how you will manage those expectations.
First, let me talk about our current capacity utilization. Capacity utilization is high in commercial categories, particularly in truck and bus radial, and in case of passenger car radial also it is high, but there is an opportunity for us to debottleneck the existing plant, so that should take care of our requirement for the next 12 months or so. The new plant producing two-wheeler tires at Nagpur is ramping up nicely. Our capacity utilization is approximately around 70% now. Going forward, we are increasing our capacities broadly in three categories. One is in truck and bus radial, where it is coming up at Halol, and we expect the first tire rollout to happen sometime in Q3 of the current financial year. The second one that we are looking at is at passenger car radial tires in the southern part of India. It's a greenfield project, and we expect the plant to start commercial production in the second quarter of next financial year, towards the end of second quarter of next financial year. Third one is at the specialty tires, which is our 100% subsidiary. First phase of the investment was for about 40 tons. Now we intend to take that up to 100 tons in due course of time. So these are the broad three capacity expansion plans that we have.
Okay. But what's the overall revenue growth expected once all the capacity constraints are addressed, and how much of it will come from exports?
See, in the current year, only plant that is going to be commissioned is the truck and bus radials. And as we would start utilizing that capacity from Q4 onwards, so it will have some favorable impact on our growth starting from Q4. We are almost running at full capacity in case of passenger car, subject to this debottlenecking. We have some capacity available in two-wheelers. So it's overall, I think we need to find out in terms of how industry is going to grow. There is an opportunity for growth of over 10%, 7 to 10% in the current year. That much capacity that we have.
Right. So how are you currently performing in the TBR segment vis-a-vis passenger cars and two-wheelers? And you believe that you can replicate the success even two-wheeler segment as opposed to TBR as well, given the kind of spurt that one is seeing in the commercial vehicle demand?
Okay, see, in case of TBR, our capacity utilization is full. Market has grown very well in the last 6 to 9 months or so. However, we have not participated in that growth fully because of the capacity constraint. Going forward, once our new plant, new capacity comes up, we expect our share of the business to increase. And as the market will also grow, we would also get that benefit from Q3. In case of commercials, we have a large presence in truck and bus bias tires. There is some shift happening from bias to radial. So we would be able to, we are working towards maintaining a current share of business in the truck and bus radial also, where our share is very low, so in the range of 2 to 3% or so. There is an opportunity for us to grow in market share in truck and bus radial.
How's the pricing pressure now in the two-wheeler space according to you?
Okay, two-wheeler category was impacted post demonetization and also during the GST transition period. We see some recovery in two-wheeler, particularly in the last 2 quarters, that is Q4 of last financial year and Q1 of the current year. Okay, we hope it sustains. Okay, and once it comes back to the normal growth levels, I'm sure we would be able to participate in the growth, as we have available capacity.
Okay, in terms of demand and long-term growth prospects, so where are you seeing the potential or the opportunity unfolding? Which segment are you betting big on?
No, as far as CEAT is concerned, our focus area continues to remain in the passenger segment. So that consists of two-wheeler as well as passenger car and UV segments. So we'll continue to focus on those 2 categories. In addition to that, we also expect commercials, predominantly truck and bus radial, to grow as the economy is recovering, mining sector is opening up, etc. So, and the government introduction of anti-dumping duty on commercial category, that is truck and bus radial tires import from China, has also helped in utilization of the local capacities better. So therefore, that should lead to improved utilization of existing capacities and could also lead to new capacities being worked on by the existing tire players, including us.
Okay. And what about your plans for other segments like off-the-road tires, volumes, margins? What is it that you're hoping to clock in?
Okay, so Ambernath plant was commissioned in October last year. Okay, and the capacity is slowly ramping up. Our plan is to set up 100 tons capacity, and in phase 1 we have set up a 40-ton kind of a capacity. We expect the ramp up to happen over the next 12 to 18 months, the current one. And we also have plans to increase that capacity from 40 to 100 tons depending on how the ramp up happens in the existing 40 tons. Our product has been very well established. The feedback that we have received from the end users or customers has been very encouraging. So therefore, going forward, we expect that category to grow.
Okay, it's been very clearly a phase of very high capacity commitment for you. A big concern, apart from margins, across the street, is also your debt levels are rising. Could you update us on that front, and also by when can we see margins move in an upward trajectory?
Okay, in terms of our ratios, we have improved on our debt equity and debt EBITDA ratios in the last 15 to 18 months. Our current debt equity ratio on consolidated basis is around 0.32 as of 31st March. Okay, and so it's an improvement about 0.08 over the same period last year. So sometime in March 2017 we were around 0.4. Even on a standalone basis, we have seen a similar improvement on debt equity, which means that we have headroom in terms of balance sheet for us to invest on capacities. With respect to your second questions on EBITDA margins, we had low EBITDA margins in Q1 of the current year and also Q4 of the previous year, arising out of significant increase in raw material prices and also lower demand just before GST implementation. We have recovered EBITDA margins significantly in the subsequent quarters. So our average EBITDA margin in the last 3 quarters of the last financial year is approximately about 12%, which is a very healthy. And in the future, we are getting into categories where the EBITDA margins are reasonable, passenger car radials or specialty sector, which is off-highway. So that should help in terms of healthy EBITDA margins. We would, in terms of our business mix, we would also have a higher share of original equipment manufacturers that may bring down our average EBITDA to the extent of incremental exposure to it, etc. But overall, we are very happy that we are getting into categories where the margins are higher than what we are earning today.
Thanks very much, Kumar, for joining us and giving us those details about your business. We wish you the very best for the future with your business plans. Take a break then. When we come back, more on the markets.